Thanks for tuning in yet again, and we shift focus to Tata Communications first. The company reported a mixed set of earnings in Q2 where net profits were lower by 32% YOY, whereas revenues rose marginally. On the QOQ basis, the numbers look slightly better than that. We caught up with the management to speak on the highlights of the quarter gone by. Here's a slice of the conversation that the MD and CEO had with me.
No, from a growth perspective, this is what we had penciled for. I mean, internally, we have greater aspirations, but the quarter has come out quite well from a growth perspective on the back of both the acquisitions, the interaction fabric, the move, the IoT fabric has really done well. So the growth is in line with the expectations that we have had.
Okay. I mean, what stood out? Because I think in terms of what people have said, that managed CPaaS, collaboration, etc., continue to remain growth drivers for you. You've known now to be a both organically growing and acquisitive, inorganic growth-led company as well. Lay it out for us for the first half. What stood out for you in terms of growth?
So the biggest growth came from the interaction fabric, driven by the Color acquisition. The second major growth we had in our IoT fabric, driven by our Move platform, which is more an organic play, largely because we've had an increased usage of the Move platform on the back of increased vehicles that we support, as well as several SOTA campaigns that in the last quarter happened. So these were the two large growth drivers. In the next-gen connectivity, after 2 quarters of a slower growth, we saw in Q2 the growth picking up. So these were the 3 big sort of drivers of revenue growth that we saw in Q2.
And you seem to be focusing on, amongst other things, and please correct me if I'm wrong here, on CPaaS as a segment. Growth-wise, it is strong. I think you're winning orders out there as well, even if deal conversions might have gotten longer. Can you tell us a bit about the strategy here?
Yeah, so we like to call this as our interaction platform. CPaaS is what typically has been used in the past. The reason why we call it as an interaction fabric is we had also the contact center on the cloud as a service. So how do you help customers to take their contact centers to the cloud and deliver a cloud-based service, which is more a voice interaction, if you will. And then the CPaaS were more a messaging interaction. So our vision is to make it all an interaction fabric for enterprise and across multiple channels, whether it's voice and make it more programmable, or SMS and WhatsApp. So yes, we are betting on interaction fabric. We are betting on the fact that enterprises will move to multiple channels besides just SMS. And we're also betting on the fact that these interactions will become more converged, and we need a software layer of orchestration driven by AI. So we are betting on all of these, and we are investing in these platforms to grow.
Is there just trying to understand, because there's so much of confusion around what data is showing in terms of growth, both locally and globally. And then there are optimists who say that communications, connectivity will be cut off from any kind of growth pangs per se. I would love to understand how you think about what's happening to global growth, which might impact your business. And do you reckon that independent of what happens there, you are on track to meet your internal guidances or external guidance as you may have laid out?
So when you say the external pangs on connectivity, see, each of the 4 fabrics that we play, the network fabric, the cloud and security fabric, interaction fabric, and IoT fabric, have their own nuances. So if you look at the network fabric, and in the network fabric, we have 2 components: the core connectivity, which actually connects all the data centers in the country, data centers around the globe. These are fat pipes that take tremendous amount of data, that makes our internet work, and so on and so forth, right? So these are the core connectivity. The core connectivity globally has been on a declining trend, even though there is an explosion of data because of the pricing erosion. Globally, the growth is on a declining trend. Whereas what we call as a next-gen connectivity and what we are betting on is the fact that, in the enterprises, the LAN that we have today are all wired LANs is going to more wireless, and the wide area network is moving more to internet, and there is a convergence happening between how LAN and WAN is getting managed, and all of this is becoming software defined. And on top of that, because you're going to internet, because you're going to cloud, the security of this is becoming important as well as complex, and that's an area of big growth, and we are betting on that growth, right? So from an overall perspective, the network as a whole is not growing in market size, but within the network there are pockets out there. For example, the whole cloud networking and the cloud connectivity is a small niche area today, about 2-3 billion, but it's slated to grow at upwards of 20% over the next 4-5 years. And we have launched our ISO Multi-Cloud Connect product there, which helps enterprises to connect to their cloud providers and exchange the data between the cloud in a more efficient manner. So there are pockets within each of these which are going to be fast growing. But if you look at the entire networking space, that is not growing that much. So we are attacking those pockets, which today might be small, but is going to be growing fast.
Okay, and which leads you to maintain the formal guidance that you'd given out for FY27, no changes there?
Yeah, I mean, that's an aspiration. Aspiration doesn't change. The macro conditions might change, and we have to just keep our heads together, heads down, and execute on what we said we would do.
But is it? I'm just trying to understand. Is it aspirational, or to your mind, it's a realistic aspiration?
No, aspirations have also to be realistic, right? So perfect. We have to pull the entire company. So it's not a dream, let me say.
Yeah. I get it. Okay, because I think the other thing that most people have written, Mr. Lakshminarayanan, is that digital growth, margins, etc., will pick up, and therefore, even if growth kind of stays steady in FY25, FY26 could be a year of fairly strong growth. Would that be a fair assessment, or is it difficult to call that right now?
So if you look at so far, year on year, albeit including our acquisitions, we are growing at, over 18-19%. So I think that's part of the whole portfolio. You can't say that you will take the acquisitions we did and take that out of the growth that we are seeing, right? Because all of that, in my opinion, adds value, adds capability, and adds strength to the company for the future. So I would not entirely remove the growth that we are getting through acquisition, because there's a lot of hard work going into integrating those companies, and the time and effort of the company goes into that. So we are quite happy with the acquisitions and the growth it's providing, as well as the capability that it helps us to build and further invest on. So, our aim is to make sure that we integrate all of these very well and set up the platform for the future growth.
So, FY26, a year of faster growth, assumptions not completely out of whack.
So, obviously FY25 has a tailwind of the acquisitions. So FY26, if you look at organically and compare organically, yes, FY26 we will see accelerated growth, and that is what we have to work on. So I commented on some of the order booking the last 2 quarters. It looks positive.
Yeah.
So yeah, I think we are quite excited about where we are.
Got it. Just one final question on a small decimal nuance, if you will, but and again, the assumptions are there in the notes and as per our research team as well, but I would love your sign off on it. The dip in margins for the quarter, there are some one-offs. You reckon the upticks will happen, and return ratios stay at these levels, or do you reckon even those will see an uptick over the course of the next 12 to 18 months?
So from a margin perspective, yes, I think we had a miss in terms of compared to the Q1. And we explained that by the core connectivity, which is a higher EBITDA business for us, that decelerated in growth thanks to a lot of cable cuts that we had. And the double whammy of that reduced growth as well as increased cost to repair all of these made an impact. So in the coming quarters, we will work to see how we can recover from that and get it back to at least a 20% by the end of the year is what we are looking at. Because also the the two major acquisitions we did were negative margin companies, and we are integrating that and consolidating that, and that drags the margins down. So all of these will come into play, and we firmly believe that that our guidance of 23 to 25% as our long-term ambition is still very, very executable and doable.